just on the major banks, look, in terms of our preferences, Westpac does remain our preferred pick. We think at current share prices, Westpac is offering the best value. And we also continue to like Westpac's defensively positioned loan book, their low reliance on markets income, which again we view as a volatile and low quality revenue stream. And Westpac also continues to have relatively high organic capital generation capacity. So Westpac is still our preferred pick. ANZ continues to remain our least preferred pick. Now, although ANZ's share price has pulled back the most this year, we still think the share price is factoring in a lot of optimism with regards to how ANZ's capital rebalancing plan will pan out. There are also some read-throughs for ANZ from NAB's quarterly trading update, which was out earlier this week. What we saw in the case of NAB was that revenue growth was quite soft over the quarter at only 1%, whereas expense growth was quite high at 5%. Now, we think part of the reason for that revenue softness and surge in expenses is likely to be that NAB has continued to run off its low-returning institutional exposures. So just to remind you, what we saw in FY16 was that three of the major banks, being NAB, ANZ and Westpac, were shrinking their institutional lending books. CBA is the only one that is yet to join that club, and we'll see. We'll get to see next week when CBA reports whether they're also running off. But going back to NAB and its read-throughs for ANZ, so look, there was soft revenue, surge in expenses for NAB, and we think that's related to the runoff of its low-returning insto exposures. In ANZ's case, look, they're running off such exposures on a much bigger scale, so the downward pressure on earnings is even greater for ANZ. So we continue to think that consensus forecasts are quite optimistic on ANZ's revenue and also optimistic on the expense side. At a sector level, look, overall, we think the sector is looking pretty fully valued at the moment. Having said that, the dividend yields are still quite attractive, and we think they'll continue to remain robust, particularly because the timing of increases in capital requirements looks to have been pushed back. So when we're not expecting new rules in Australia stemming from reforms to Basel III to become effective before FY19. So that does provide the banks with more time to bolster their capital levels. So again, Westpac's offering best value in our view. It's our top preferred major bank, and we have an add on it. We have a hold on the other three major banks.